Hello and welcome to this interview here on Money Paathshaala. Joining me today is one of India's finest fund managers. He has built a lot of wealth for investors, someone who's been in this industry and has very closely monitored India's stock markets for close to 2 decades. Joining me today is Shridatta Bhandwaldar, who is the head of equities at Canara Robeco Mutual Fund. Thank you very much, Shridatta. It's a pleasure talking to you. And as I mentioned, that you've had a very good run with your funds. You command a lot of respect among investors. So thank you for taking time out to share your advice with them. My first
Thanks, Vivek,
question
for
to you.
having us on the show. Thank you.
Thank you. My first question is, we recently saw a very sharp rise. We were seeing all-time highs every day. Of course, there's a slight lull now, but even then, as we are recording this interview, we are above 66,000 on the Sensex. 18 months, the market went nowhere and people were, getting restless. But I think this real jump up seems to have excited them. What do you make of the valuations at the current levels? Do you think we are now in an expensive zone, or do you think that this was only expected and there is far more legs to this market going forward?
So you asked actually multiple questions in one question. So let me start with the last question first. Uh, statistical valuations only tell you something, a particular part of market. It doesn't tell you the whole story. If you have to actually think about the whole picture, if you have to actually construct a thesis, you have to always think about the growth profile of the corporate India, the growth profile of the market, and then look at valuations in that context. So both things are equally important. My hunch is, and my experience over a period of time is the first thing, which is the growth part, and what is your perspective on growth, what is your view on growth, and sometimes you can be right, sometimes you can be wrong about that growth estimations. But having a view on that, and if that growth view is a constructive, then valuations sometimes can always take backseat for some time. Of course, you have to look at them in terms of the long-term averages, in terms of how away they are from mean. That also becomes critical. But the first and foremost is the growth profile. So let me start there. As you said at the start, market is at new high. Of course, market is at new high for a very simple reason. If you have to actually bring it down to the fundamentals, market is at new high because the earnings are at new high. So if you actually go back and check earnings in, say, and I'm just taking that reference point because it was a pre-COVID period, calendar year 19 end, your earnings were estimated to be about 470 to 500 on Nifty. Okay. Today, for financial year 25, the earnings are estimated at anywhere between 1050 to 1100, depending on the research report that you are taking. But consensus is around 1050, and this is what the market is discounting today because 1 year forward discounting is happening. So if the earnings have more than doubled, of course the market theoretically, adjusting for sectors and multiples within the index composition, it should double, and that's what you are experiencing. That market is that new high because the profit growth has over a period of time happened. The earnings growth of the Nifty has been in healthy double digit through COVID period. If I take last 4 years, so that's the predominant reason. One. Having said that, second is, how are we looking at earnings today? Because that becomes more critical from today onwards, or from future perspective. Because market, as you are rightly alluded, market has already moved 12-13%. So how we are looking at it is very simple thing. That you came out of COVID 18 months back or 15 months back. There was a lot of enthusiasm in terms of how the earnings are likely to play out in commodities, in energy, in IT sector. You would have heard all those words, IT super cycle and commodity super cycle, 18 months back. When we came out of COVID, everybody thought that consumer discretionary part will continue to do as it did for first quarter, which did not happen. So there was a lot of exuberance which were built in numbers. So earnings estimations that were there 18 months back were running far ahead of the fundamentals, and not because it was intentional misleading by the community or generally research guys, but it is just that we are operating in an environment which is very very unusual. So you are not getting the trends necessarily right. So everybody thought that IT is going to continue to do well, commodities are continuing to do well, you're going to have consumer discretionary. None of that happened. Financial year 23, you had almost 7 to 8% earnings downgrade from where we started. And when you have a earnings downgrade cycle like that, 7-8% coming off a higher valuation, in October 21, we were trading at 22, 23 times 1 year forward earnings. From there, you had 8% earnings downgrade. And second factor which matters for the valuations, which is the interest rate environment or cost of capital. Theoretically, interest rate environment and valuations have inverse correlation in a very, very loose term. Your interest rates globally and domestically moved up anywhere between 200 to 500 basis point. So both the factors, you came out of exuberant period of estimation, you had earnings downgrade, and you had cost of capital moving against you. From there, we have moved into a period where earnings estimates are far more realistic today. Earnings are largely estimated from domestic cyclicals, which means nobody is estimating global cyclicals to do well. Earnings are largely domestic today. So financials, auto, industrials, domestic pharma, telecom, cement, real estate, any sector that you take today, where the earnings are predominantly relatively more resilient or constructive, is largely domestic. Today, the earnings estimates are 13 to 15% CAGR for next 2 years, which, in my view, are far more realistic. Doesn't look like there is anything disproportionately built in numbers. You can always get surprised if global slowdown actually turns out to be adverse, really adverse. But that is where the market actually took that clue that okay, incrementally after fourth quarter, the earnings are not incrementally that bad. They are far more realistic. You have had 18%, 15, 17% of earnings growth, but market not going anywhere, which means you had market corrections effectively, not price correction necessarily, but time correction. Your valuations had come to a reasonable level to start with, and then you had cost of capital equation changing. See, while it is not well appreciated, the same cash flow is discounted at 200 basis point lower, which means far lower valuation multiples theoretically. While the interest rate environment has not turned as of now, but there are all indications that 3, 4, 5 quarter down the line, and market is a forward discounting mechanism, you're going to have interest rate cycle also turning in your favor. So both the factors, from domestic earnings perspective, the consolidated earnings are likely to grow at 13 to 15%. And then on top of that, you have an interest rate environment, you have a cost of capital equation, which is turning in favor of financial assets. It's not to do with India, it is to do with all global financial assets, depending on where the earnings is in the context of their respective valuations. So that's what effectively has happened, and that's where we are not taking a very very negative view on market just because market has moved up 12%. Market did not move for reasons I alluded to. Market moved because incrementally earnings growth and the valuation construct is looking far better. Having said that, of course, we were thinking that the 12, 13, 14% return will happen over next 3 quarter, 4 quarter. It has gotten compressed. So there is a little bit of upfronting that has happened. And to that extent, you might experience some time price correction combination of all those things for next 3 6 months, and which would be good actually for market if market were to time price correct whichever way, either price correct or time correct and get you some consolidation, because you have discounted a little bit of at least earnings for financial year 24. Having said that, now how do you look at the valuation multiple, and do you really get worried about financial multiples? Typically how it happens at individual security level, and that's the way I'm explaining at market level. India as a country is a, say, a stock effectively, correct? It's like a individual security in global market. If your growth profile is in near term is good, which is what I alluded to, 13 to 15%, and from a structural perspective, if you're ticking all the boxes in terms of differential of growth, differential of capital efficiency, the kind of judiciary system that you have versus most, in fact, all emerging markets, I can say very so comfortably all emerging markets, the continuity of political establishment, which is we are taking given today. If that there were to be some risk there, that can be a problem. But oh, and on top of that, you have a diverse, very very vibrant private sector uh, driven capital market. It's not a PSU heavy. It is not a it is not a commodity heavy market like most of the other emerging markets. So these are clearly differentiated traits, which differentiate India from rest of the world. So if you have differential growth, capital will come there. How do we select stocks? How do we choose a stock security A over security B? Simple. Uh, Along with capital efficiency, where the growth is superior for next 3 years, 5 years, or structural factors. So near-term earnings as well as long-term structural drivers in place decide what kind of multiple you will get. So those are the factors which favor India far more today than most of the other competing markets who are actually attracting the same capital from global perspective. So that gives me far more comfort that with this kind of earnings in near term structural constructive aspects in place, will valuation multiple go to really historical averages of last say 15 20 years of 16 16 and a half 17 time 1 year forward? I have my doubts that will happen. So that's a very long answer to the short question that you asked first. And on top of that, actually, what has clearly changed is, and I would actually summarize it because otherwise I'll take a lot of time, is basically after typically when you take a little medium term view on any country, you have to take view on balance sheets ultimately. Okay. And typically if your balance sheets are clean and if they are going to expand or reflate, okay. So if you look back between 14 to 20, you had balance sheets of banks, corporates, okay, both which were getting compressed. And when corporate and bank balance sheets are getting compressed, ultimately your consumer balance sheets also beyond those top 10 20 crore people actually get compressed because there is no incremental job creation, there is no incremental wage hikes, and all the allied factors, tertiary secondary tertiary job creation which happens along with that. You have moved from that phase to a phase where most likely outcome over next 3 years, and I'm saying with all sensitivity, most likely outcome for next 3 5 years in India is that you are in a credit growth cycle, okay, your credit expansion cycle. You are in corporate with corporate balance sheets which are completely clean. They will be in a reflation cycle, which means they will expand their balance sheet, which means they will start investing. So out of the three key stakeholders in economy, which is the corporates, which is the private sector, sorry, corporates, banks, and the government, you and probably household, four balance sheets, you have three balance sheets which are either positive or constructive. It is only government balance sheet where fiscal deficit is still high, but then they are compensating it through the kind of policies that they are running, whereby they are actually focusing on PLIs, they are focusing on actually formalizing economy, they are focusing on basically actually moving on both sides of creating disincentive for informal sector, creating incentive for formal sector, and at the end, whatever incremental resources they are being able to generate, they are investing it properly in capital asset creation rather than distributing it among poor in terms of food or in terms of schemes and all that. Rather, they're actually focusing on creation of roads, railways, defense, everything. Capital investment, which actually leads to far better long-term outcomes. So when you look at all these things, you're in a reflation cycle, you're in a business cycle, you're in a credit growth cycle, and you have a government which is supportive in terms of asset creation versus consumption in the economy. All those factors are on positive side of economy. And when I actually look at all these factors, it tells me that why market is generally trading at a higher multiple is not near term earnings growth, but it is, everybody is understanding this, that probably next 3 5 years most likely outcome is going to be you're probably going to expand earnings growth at 13 to 15% for next, not only next 2 years, but for next 3 5 years. You're in a business cycle, you're in a credit growth cycle, because when do you get business cycles or credit growth cycles? When balance sheets are clean and you have cleanest balance sheet that is possible. I mean, just banking results are coming out. Virtually every top 10 banks, except probably a bank, if you can think of, they're sitting on something like 16 17% of or 18% of capital. I mean, what are they going to do with that capital? Same with the corporates. So when I look at those factors, uh, I don't get too worried about multiples. Yes, market tactically, will market have price time corrections because market has upfronted a little bit. Yes, but when I look at all these factors, when I look at differential growth, clearly it looks like you have 3 5 year runway this time around between, and there are one or two statistics which are clearly standing out between 15 to 20. You had single digit credit growth, high single digit credit growth. You had high single digit Nifty earnings growth, which has already moved to basically double digit earnings growth, double digit credit growth. In fact, credit growth has been surprising even last 3 4 months when I was thinking that okay, base is high, so our credit growth should be coming down from 15, 16% to say something like 11, 12%, 13%. It is still stuck at 15%. So, which tells you about the underlying activity that is happening in the economy. So, all those factors give me quite a constructive uh, data points to not actually put valuations at front, but keep valuations at the last.
Hmm. So you're bullish India.
I'm very constructive on India.
What about the small cap space, Shridatta? Because there again, of course, that's not reflected in your major indices that hit the headlines, but large number of stocks have hit highs. Some experts, few experts are also saying that certain pockets are almost reaching a euphoric kind of a stage. What is your view on the small and micro cap category?
Micro cap, we won't be able to offer a view because we don't track
Sure.
them.
Yeah, sure.
But
Small
small
cap.
cap, we have a fund, so we can offer our perspective on that. I largely concur with my peers from industry that yes, are there certain pockets where the earnings valuation context is becoming far more unreasonable. Yes, there are pockets like that. Second, but why it is happening is also because typically the sensitivity to the incremental flows in these categories is far higher as compared to the large cap or larger mid caps, where the large amount of capitals can get absorbed. Whereas if you look at the monthly mutual fund flows generally from near term perspective, they're far higher in small cap and mid cap category, which are relatively predominantly owned by promoters and then institutions. So there is relatively less liquidity, and that's why you get disproportionate price moves for incremental smaller incremental liquidity. That is clearly happening, and which has led to certain pockets becoming unreasonable. But that is again one way to look at it. I mean, just think about, step back and think about it. If you're a small cap investor, you're coming in a category which is relatively illiquid, correct? Which is relatively more volatile. But you are coming with the expectation that I want to garner little higher returns over a period of time, which I should be compensated for the volatility or illiquidity that I'm taking, with a belief that okay, India is a fairly large, diverse, broad economy, and if we are in upcycle today, that which is what our thesis is, there should be a lot of businesses in broader market which should do well, whether it is small cap, mid cap, large cap. That's a different point, but generally in broader market, we should do well. If that is the case, uh, while the liquidity might have constrained the opportunities in near term, if I step back and think, yes, will there be vehement reactions to incremental negative flows in those categories? Yes, just like positives, there will be consolidation, there will be negative reactions, and again there will be accentuated, just like what happens on this side. But if I start looking at that business cycle and I start looking at okay, which are the broader market sectors or companies, and particularly in small caps, it's more company specific rather than sector specific. Uh, if they are going to participate for 3 5 year in a journey of operating and financial leverage, should I rather focus on actually pockets where that can happen? That's what we are doing. We're rather focusing on okay, which are the pockets where in our broader thesis on top down, the bottom up is matching in terms of earnings growth profile, improvement in the financial operating parameters, uh, and start participating there with a 2 3 year view rather than, because I don't believe anybody is coming, and if somebody is coming, he should not come in. Nobody should come in small cap category with a 3 month view, 6 months view, or 1 year view. So just like what you experienced when market was consolidating, that part of the market took bigger hit. On the other hand, when the market is actually doing well, that part of the market is actually doing disproportionately well in near term because the liquidity reactions are much stronger. So there are pockets, but uh, from a 2 3 year perspective, 5 year perspective, which is what any incremental small cap guy investor should think about, I think we are not too worried.
Hmm.
It is just that, of course, you have to work harder and harder when so much of liquidity is flowing in a particular category which is relatively liquid.
Shridatta, what would you tell a young person who has not invested so far and is, while we've seen a lot of attention on mutual funds, more folios being opened, but yet If you look at the size of the country and if you look at the population, we are still a very small fraction in terms of penetration. A lot of young people are today consuming information. Yes, some are choosing to trade, and you made that point that, be very cautious about certain spaces, have a far more longer term view. But someone who wants to invest in a mutual fund, and you've very nicely brought out the journey of how you see things, over the next few years, not just the next few months. What would be your advice be to to a young person who is choosing to start her investment journey?
So I think anybody who's actually it's sometimes a lot of information that flows is positive, and most of the time it is actually adverse for a individual who's not from the industry, because there's just too much of information which is flowing. I think what individuals should focus on, and particularly the individuals who have not invested, and which I keep telling all the, including including my acquaintances who are not part of market, is that you just look at basic purchasing power increase that happens in equity. Okay, if you actually do any other instrument, basically you get 5, 5, 6 post-tax max. I mean, you'll get 5.5% of post-tax returns. Whereas this is a category where you take 5 year, 10 year, 15 year, 20 year. You consistently have had a purchasing power increase or returns which are double digit at least. If that is the case, you are giving up on huge opportunity to create wealth by looking at near term, because you see that volatility in market, you see in news flow that okay, market has corrected, market has actually gone up, and all those things. People should focus on their goals. What is my goal? If I need X amount or X kind of corpus at a particular stage, what kind of amount I need to invest in mutual funds or any other instrument, whether it is direct instrument or equities, or mutual funds. If I can generate 10, 11, 12, 13% return CAGR over a period of time, what are my goals and what kind of allocation I need to have? And this question actually keeps coming back to me always. Basically, most of the people focus too much on the news flow, the near term, what is happening in market, what is happening basically in stocks, and they focus too lesser time in terms of thinking through that if I actually allocate a particular part of my savings to this instrument, it has a potential to generate 500, 600 basis point of higher or 5 or 6% higher CAGR or fixed rate instruments. What kind of wealth I can create? Because ultimately, uh, if I allocate 0.5% of my saving or 1% of my saving, however I keep debating about market, it is never going to help me, because it is not going to translate into wealth for myself. So allocation is something which is so basic. One, the purchasing power differential between any other instruments of mutual funds or equities vis-a-vis the other instruments. One, and second, once you understand that, how much of allocation you're making, because unless your allocation is little sizable, you're not never going to create wealth. There are a lot of people who actually indulge into individual stock trading, and I'm not saying right or wrong, it is their own choices. But if you're doing it in 2 rupees of your 100 rupees savings, even if you make 100% return, it doesn't make any difference to your wealth actually. So it's just a psychological satisfaction you're drawing out of that activity rather than creating wealth. If one has to have a goal based investment, if one has to have allocation based investment, if one wants to create wealth, I think he needs to focus on two things: that returns in equity market is 5-6% on an average higher than the inflation in the country. One, second, returns in market is not casino. Returns in market is a function of the growth profile of the country and growth of profile of the corporate India. And just to put a statistics to it, last 18 years, and I just took, don't ask me why 18 years, I will just taken from 2005 to 23, just randomly. You can change the period and it will come out to be same. Your nominal GDP growth rate is almost 11% in India, and your corporate earnings growth is 13%, 13.5%. Okay, and this is aggregates. You can have 100 50, 70, 100 companies out of that who would have generated probably much better return profile. If the earnings profile or growth profile of your country and your corporate India is so good, and we are still at 2,500 per capita, and such a good demographics. You're going to get that growth in the nominal GDP growth rate, and you're going to get that growth in the earnings profile of the corporates. And if you get that earnings profile growth, you will get that reflection in returns, because stock price performance or market performance is nothing but what happens to the underlying earnings growth of the individual companies and market as a whole, or portfolios as a whole. So first, basically, differential versus the inflation, how much purchasing power. Second, market returns is a function of underlying growth, and you have growth in India. And third, once you understand these things, focus on long term and keep doing allocation, because if you allocate 1 rupee out of 100 rupees, it is not going to make much of a difference in your life. But if you do over a period of time, and I'm not saying in one go, because people are not experienced in market, so volatility can actually make them fearful. But if one actually, whichever way, SIPs, STPs, whichever way they want to allocate over a period of time, if they make some sizable allocation based on their goals of whether retirement, whether marriages, whether education, whatever, of 5 10 years, if they keep doing it systematically on a sizable allocation, I think after 3 years or 4 years, they don't need to hear us. They will tell us how equity is good. And I have heard this uh, from thousands of investors over last 8 10 years, in terms of how their own view about equities had changed after first 5 years, 4 or 5 years. Because typically the tendency of the investors is to come when market is euphoric. So typically their experience over first 1 or 2 years is generally not good on an averages,
Correct.
because the largest allocation typically happens when the market is has already done well.
Hmm. Very
So
true.
these are a few of the kind of nitty gritties that I think are things that I think new investors should focus on.
It's been a pleasure talking to you, Shridatta. Thank you very much for taking time out. I know these are very busy times for you as a fund manager, as a head of equities, but you took time out to talk to young viewers. Thank you very much, and I look forward to many more such conversations as we go along.
Thank you. Thank you for having us on the show. Thank you.